So today we're going to talk about how to get the best interest rate in any economy, especially in this high rate environment that we're in right now. Hello, this is David Zai with the Zai Mortgage Team. Interest rates are certainly at eye-watering highs right now. And one of the biggest things that we always talk about is, I talk to this with my family all the time, and we're always talking about, hey, when we find a sale on, let's say, eggs, because eggs are so high right now in price, have you seen the lines of people that are out there buying eggs or getting things that are on sale? But when people are shopping for their mortgage, they don't do the same thing. And this could really save them tons of money. So it may seem like every lender out there is offering the same type of rate. However, I'm going to give you some tips and tricks on how to get the best mortgage rate in any environment, especially in this high rate environment. Number one, your rate. And let's talk about, before we go into the points and the factors, let's talk about how the interest rates are going to affect you, okay? So your mortgage rate is influenced both by the monthly payment and how much money that you put down and how much in points that you decide to choose up front, which is upfront interest, so that you're paying less. So to give you an example of how interest rate is going to affect you, basically, if we were to use a 6.5% interest rate right now, instead of a 6.75% interest rate, which is really a 0.25% difference, which seems like very little, okay? What is the difference on a 30-year loan? Well, that means that for every $100,000 over that 30-year term, you're going to save $7,500. Is that not worth shopping or not? Well, for me, I can tell you right now, it's certainly worth shopping for me. So what the lenders take into consideration when they're doing a mortgage is we look at your down payment, how much you're putting down. So it's called loan to value, and that's how much skin you have in the game, right? So loan to value is how much the loan is versus the value of the home. So your value is typically going to be higher, and then your loan amount is going to be lower. So 3%, 5%, 10%, 15%, 25%, so on and so forth. That seriously makes a huge difference. Now, the appraised value of the home, so if you're getting great value on the home, then that's always a good thing, right? Especially the next time the interest rates drop, which typically with the interest rates dropping, it's almost like a rock on a trampoline. Boom, rates or values start going up, okay? So rates drop, values go up. Rates go up, typically values come down. And it's not like 2008 and 2009 anymore, okay? The values aren't going up with the interest rates and down like this because everyone's got great rates on their home. So if you're waiting to buy a home, there's really I may not be the smartest guy here, but I can tell you right now, waiting is typically not the best thing to do because you really can't pinpoint when the market is, right? And when it's going to go up, when it's going to go down, when it's going to stop doing what it's going to do. So I would always say, tip number one is marry the home and date the rate, okay? When you're getting value like you're getting right now, I just got a contract in today and we had on a $250,000 loan amount, we actually got $12,000 in closing cost. 6 months ago, we hit the rewind button, I can guarantee you we're not seeing that type of value on homes, okay? You would have had to pay on that $250,000 home, maybe $280 just to get into it. So you're going straight into the property, negative equity. You're making up the appraisal gap. So that is definitely a different market than we're in. However, you were getting rock star interest rates. The 2 and 3% rates were out there at that time. Tip number two would be to improve your credit score. Credit score always makes a difference, right? Just like, with everything else, when someone's evaluating your worthiness to rent a home, to buy a car, to get a credit card, the credit score is the number one thing. So a lower score means that you're going to have less programs to choose from. A lower score means you're going to have more loan level pricing adjustments to kind of go through. And what that means is typically, you're not getting your options of all the conventional products out there when it comes to that lower score. So we look at a chart and we're looking at now the bottom left corner, whereas if you're looking at the upper right corner, which is the best loan to value, which is more money down, and the highest score, you're going to have way less loan level pricing adjustments versus something when you have the lowest score. Tips to kind of help improve your credit score: definitely make your payments on time, okay? Anytime you're late for anything at all, that's bad. If you have to make minimum payments on everything just to survive the month, go ahead and do that. Keep your utilization low. If your credit limit is $1,000, make sure you keep everything under 50%, right? 50% is just the minimum. So getting it to 30% is going to be better. Getting it to 10% is even better. So always, always, always work with your loan officer on that. If you're pushing up against the 50% mark at that point, and you think you're not going to be able to make those payments, at that point, immediately call your credit card servicer and ask them for a credit line increase. Getting that credit line increase from $1,000 to $2,000, and let's just say you're at a $500 utilization right now, this will give you another $500 buffer to make sure that your credit score doesn't go down. So when you're applying for this loan, it doesn't affect you in the long term like that 0.25% and $7,500 for every 100,000. Always keep your usage low. Make sure you don't have a bunch of accounts out there. Make sure you don't go out and you apply for every single type of promotion that they're giving you, and just to get denied, because that's the number one thing that's going to drag your score down, is doing something like that. Building a steady employment record. As a lender, I'll tell you right now, having that 2 years of employment history is important, right? Having big gaps in employment are going to kind of limit you once again to the type of loan programs that you can have. If you're self-employed and you have declining income, well, that's going to lead to less of a qualification for you. And if your income's increasing or steady, then we'll be able to use that income and help you qualify based on something that's affordable. So people that shock their tax returns, like, hey, I know I'm getting ready to buy a house, so I'm going to write the rest off. Well, that's not really helping you out because those expenses are still there. Or someone that's self-employed and they don't write anything off, and all of a sudden they're writing things off. Well, you may qualify for the home now, but if the rates were to go down, you're not going to have that opportunity to refinance and save money. The fourth step would be to save money for down payment. Down payment, right? It's really the name of the game. At like a 6.5% interest rate for every $10,000, that's pretty much going to affect your monthly payment between $65 and $70 per month. The more you have down, the less that payment's going to be for you. It's going to make everything else more affordable. So you have to factor in things such as, maintenance and expenses that are required in the house, your utilities, your furnishings, your appliances, all these little things that kind of go into it. So if you have to decide between, putting more money down and going out and getting a high rate credit card to kind of cover all of your supplies that are needed for the house, that may not be the best thing. So definitely work with your loan officer, or hopefully myself, and make sure that you're checking to make sure that you're seeing, if I put 10% down versus 20% down, what the difference is going to be. If I took that 10% or less down, what are my mortgage insurance options if I'm getting a conventional loan or an FHA or a VA loan? And how will that benefit me, the 10%, if I were to use that to go buy my furnishings and everything else in the house versus going out and getting that high rate credit card at double digit interest rates? Is that really the best utilization of your money? That's something that you really need to factor into it. If I'm taking the loan out right now and it's a higher interest rate environment and I get that opportunity to refinance, am I really going to want to put as much money down and take on those additional credit cards? So the less money that you put down up front, and if you were to just do a refinance, a rate term, it's going to be a lot cheaper. The more money you put down up front and you know that you're going to have to potentially do a cash out refinance, that's going to be way more expensive. So definitely factor all that into it. Next thing, understanding your debt to income ratio. Huge, huge thing, okay? Knowing what your debt to income ratio is can be the difference between you getting that conventional loan or FHA or USDA or VA loan, or even a non-conforming loan. What does that show us, okay? A debt to income ratio shows us how much ability and flexibility you have when it comes to making your monthly payments, as well as your bills on top of that. So if you're going into a home and you only have the home payment, well, your debt to income ratio should be low, okay? But when we start factoring student loans, auto loans, credit cards, all this other stuff, now that's your back end debt to income ratio. And we look at both front end and back end debt to income ratio when we evaluate the type of terms that we're going to be giving you. So once again, that's on that thing that's called loan level pricing adjustments, okay? So depending on the risk that we have, there's going to be adjustments to your loan, and that's going to affect the cost of the loan when you go into borrowing it. The next tip would be, consider alternative financing, like 2-1 buy downs, 3-2-1 buy downs, 1-1 buy downs. What are those, right? That means if you start out with a starting rate of 6.5% And let's just say we really need to get you a little bit of savings up front because maybe you're expecting a job increase, or maybe you're someone that's going through med school right now and you're making very little in your residency, and all of a sudden, you're getting ready to go out and be a full-blown physician, so you're going to make a lot more money. These are really good alternatives to help you save money up front. You're going to get that temporary relief up front. So let's just use that 6.5% rate again, okay? Not talking rate here. We're not saying that this is the rate that I'm going to be able to give you right now, but let's just use that as the mark, the guideline, okay? We get a 6.5% rate here. We get the seller to pay for part of the closing costs, and there's a buy down calculator that we use. And if it's a 3-2-1 buy down, okay, that means at the 6.5, you would get a 3% break on your first year. So 4.5 first year, 5.5, 6.5. So a 3-year break on the interest rate. Also, adjustable rates are really important to go with, or not important. I would say something that you should weigh out just to see what that looks like, right? So my mother-in-law, when she first bought her house, it was a very crazy, extravagant buy, okay? However, she was in an adjustable rate in a higher rate environment. As that rate started going down and the rates were adjusting every 6 months, there was a point in time that her interest rate was like in the high 1s, low 2s. It's not all bad. Sometimes I'm not encouraging you to take an adjustable rate if you can't budget for that adjustable rate. But, looking at different types of like alignments or alternative loan terms would be something that I would look at as well. Looking at multiple lenders, we talk about this all the time, right? How are you going to save money? You're going to save money by making sure you get the best terms. We shop for our eggs. We shop for our groceries. We shop for our clothing. We go onto online stores as well as in-store just to compare prices. Why are we not comparing it with the lenders, okay? The biggest comparison and the biggest savings right off the bat is going to be going with wholesale versus retail. There's a lot of benefits that we can talk about, not only from the saving standpoint, but from the qualification standpoint, right? So what I mean by that is, you go to one lender, one retail lender, that retail lender is going to give you that rate. However, that rate may not be the best rate, number one. And if you were to get denied, that's going to be the only option. So when you get denied, they then call their friend down the street that is a wholesale mortgage broker like myself and says, hey, do you have something that fits this box? Let's just say we pulled the credit score and it was a 620 at the retail lender. And all of a sudden, during the process, let's just say you go out and you buy a bunch of things and then your credit score goes down. What happens then? Well, at that point, your credit score may drop to, let's say, 600, and now that retail lender that has that minimum credit score of 600 does not or 620 does not have an option for you. So they're looking for someone like us that has multiple options. The options are not only going to be able to help you get into the house, but it's also going to give you the ability to shop the entire rate sheet so that we're giving you the best value. So always comparison shop. Get that loan estimate, get something in writing so that you can see exactly what's going to be charged. If they're offering you the rate, ask them if you can lock it right away. Typically, rates cannot be locked. So that's the next tip, is locking in the interest rate as soon as you've identified the property. I'll tell you right now, especially with this rising rate environment, the best approach that I've had was no longer looking in my crystal ball to check out the interest rates, okay? Because no one knows. I don't know. All the market analysts out there that tell you that they know don't know. There's nothing set in stone to say whether the interest rates are going to go up or down, especially in a short period between you ratifying a contract and going to closing. Any opportunity that you have to lock in that interest rate and not gamble is definitely a big thing. So you cannot lock in an interest rate before you get a contract. There are some lock and shop options, but those rates are typically a little higher. We do offer things like that. If it's a longer lock that you're seeking, more than 60 days or 90 days, and your lender doesn't offer it, make sure you call a wholesale mortgage broker, because someone like us, we can offer it. So in conclusion, there's a lot of economic trends. It's really hard to keep up with, but I'll tell you, owning a house versus renting a house is a big deal, okay? When you're renting a house, you're giving your landlord a bunch of money. And coming from a landlord, I really appreciate you for giving me the money, right? However, long story short, owning that house and being able to pay it down every month and having that principal balance go down and hopefully getting that value to go up when the rates come down is always a good thing. I'd love to help you out when it comes to, navigating through all these like treacherous interest rates and different loan programs. My name is David Zai. I'm with the Zai Mortgage Team. I can be reached at 757-478-8493. And I'm just saying, give me a call.